So now we'll discuss how you would go about calculating your tax EBITDA. So you start with your taxable income, and this is inclusive of recoupment of losses. Then you make certain adjustments. You will add back the net debt deductions. So two terms here that you need to be aware of. The term net, which is expense minus income, and the term debt deductions, so which is far wider than interest expense. It includes anything similar to interest. So it would potentially capture interest rate swap costs or guarantee fees, which you pay on the loan. So it's far wider than interest expense. You also add back your deductions under Division 40 and 43, which is tax depreciation and capital works, but not amounts relating to capital expenditure, which are immediately deductible. You also subtract dividends and franking credits and trust and partnership distributions where you hold at least a 10% stake in that investment. You also make adjustments if you are in the R&D industry or have made R&D claims. Also, when calculating the tax EBITDA, because corporate tax entities can choose whether or not to recoup losses and how much it chooses to recoup, when calculating the tax EBITDA, you are assumed to recoup all available losses that you could recoup for that year. So let's look at a simple example of the calculation of the tax EBITDA. So on the left of the screen is the P&L, and on the right side is the calculation of taxable income and tax EBITDA. So a few things to point out from the P&L: interest income is 100,000, accounting depreciation is 1 million, interest expense is 2.5 million, and net profit before tax is 2.1 million. So let's calculate taxable income. You start with your profit before tax, add back the accounting depreciation of 1 million, subtract depreciation, tax depreciation, and capital works, and these are assumed numbers to arrive at the taxable income. So now you can proceed to calculate your tax EBITDA. Firstly, add back the net debt deductions of 2.4 million, which is interest expense minus interest income. You then add back your Division 40 and 43 deductions to arrive at your tax EBITDA. Multiply that by the fixed ratio of 30% and compare that to the net debt deductions. If the net debt deductions exceed this number, then the excess is added back. So you can see that these calculations, you can potentially model this for your group if you have not already done so. And if you have net debt deductions being denied, it is worth having that discussion at group level as to whether or not it's worth restructuring your debt levels and capital structure.